something like that, you're going to satisfy your customers whatever you have to do to get the ingredients for the systems that you need to put in your missiles. So spread that across the entire industrial economy, and you have a lot of stockpiling going on, maybe. Once again, in the face of a big deficit and shrinking above ground supplies. So we're getting close to the point of some kind of a squeeze in this market where, somebody takes a huge amount off the market. That causes some turmoil at the exchanges. That causes everybody else who's in the same boat as that first big buyer to panic buy.
Financial analyst John Rubino warns of an imminent financial reckoning. Japan's spiking bond yields, 10-year 1.94%, 30-year 3.39%, with 250% debt to GDP, threatens to collapse the yen-carry trade worth trillions. Gold tracks Japanese yields since 2011, signaling approaching crisis. Central banks and crypto firms like Tether buy gold regardless of price, preparing for monetary reset. CME's suspicious Thanksgiving shutdown during silver's breakout reveals fractional reserve system where claims dwarf physical supply. Industrial and monetary demand exceed mine output. Rubino predicts silver becomes unobtanium when squeeze triggers panic buying. Subscribe to Fine Metals for more updates.
Well, I think the silver thing is a potentially big thing that some people might call a black swan, but it just looks like the math working out. So we get a squeeze in silver. Another thing that might come along with that is something similar in copper, because that market is pretty tight. The yen carry trade, which we've already talked about blowing up, is a potential. Again, it's a black swan to anybody who's not paying attention, but it's a very big possibility as a crisis out there, and the biggest thing of all, though, might be the Fed easing aggressively, which it's already getting ready to do. Trump is getting ready to replace Jerome Powell as the chairman of the Fed with one of his guys, some of whom have been explicitly talking about a big drop in the dollar's value. Relatively small scale, though. Rates went down at first when the Fed started cutting, and then the 10-year yield went back up to kind of where it was before. But it could be bigger this time, where it spikes to some unmanageable number. And then you got everybody looking at the government's interest expense, which is now $2 trillion, and that dwarfs the military budget by 50%. That kind of thing. When you see that kind of math on CNBC and CNN, then people get seriously spooked, and nobody wants to own the bonds of a country that is running those kinds of numbers. So something like that is conceivable in 2026. And if that happens, then that means we're kind of at the end of the fiat currency experiment. So this is potentially very big for economic history. We tried this experiment starting in 1971, where we trust governments to effectively and honestly manage our currencies. And they basically screw it up on an epic scale. And so over the next 50 years, we become more and more deeply indebted. The 95% who aren't super rich become debt slaves to the 5%. And you would expect actually a much bigger correction than we got, because it blew through $3,000 an ounce and then through $4,000 an ounce, which created a lot of profits for people to protect. So it wouldn't be a surprise with a chart like that for a lot of people to take profits up above $4,000 an ounce, and for it really to knock down the price of gold. That doesn't happen is probably because central banks are the whales in this market right now, and they're not price sensitive. They are tonnage sensitive. They've been ordered to accumulate X tons of gold, and so they're buying it regularly without worrying about the price, because that's not the issue for them. That's a good sign. That means that people are interpreting the commodities exchanges playing games as a sign of weakness rather than a sign of strength, and which they should. I mean, that when commodity exchanges do things to stop trading, that means they're worried about what's happening if they don't stop trading. And that is a very big sign of weakness. That means they don't have the metal on hand to make good on all the claims on that metal that are now trading on their exchanges. So, I mean, and that's the case. It's kind of a fractional reserve banking system in the metals markets, especially silver, where there are claims that dwarf the amount of physical metal that's available for delivery. And so you can't have all those claims stand for delivery because the metal's not there. Yeah. So exchanges tend to do things to limit volatility in the commodities that trade on the exchanges. They'll change margin requirements in a way that makes it less attractive to hold futures contracts, things like that. And so it could be that this is in the same category as that, but it was something that happened on the spur of the moment, and it was kind of an emergency thing. It was something that was derived more from panic than from any kind of policy, but I don't know. And the fact that silver wasn't really fazed by it, although silver's down today, so maybe we've got a delayed reaction happening today.
And here we go, John. Look at that. Look at that correlation here. I'm going to make this a line graph, and yellow is Japanese 30-year yield. Blue is the gold price. And I mean, they've pretty much been moving in tandem now since 2011 or so. You look before 2011, it appears that they were inversely correlated, let's say. But since 2011, since that peak in gold, they've been moving pretty much in tandem. You did have a little bit of a delta here between the two from 2018 up until 2022. And here's that magic year when everything kind of broke. 2022 is when interest rates started to break out. 2022 is when you started to see gold start to really move on to the upside, as you saw here with this blue line. And since 2022, the two have been inseparable. The interest rate, the Japanese interest rate, as well as the gold price.
The gold is telling us that the higher Japanese interest rates go, the closer we get to some kind of a financial cliff. And you want to be in real money when that happens, not a fiat currency that has to be inflated away in response to some kind of a crisis. So, I mean, your and my investment thesis from all of this has always been that you want to be in precious metals and other kinds of hard assets. And this chart just shows that a lot of people have made the same decision.
At 1.94 at the time of this recording, Japanese 30-year also at 3.39 at the time of this recording as well. Both are rocketing higher. What does this mean for the average investor? What does this mean for the world?
Well, to understand the significance of Japanese interest rates, you have to understand the yen carry trade. And basically, for the past lot of years, Japan has had artificially low interest rates because their government has been borrowing just crazy amounts of money, thing like that. So that's where Japan is now. Now, the U.S. is heading for that way or for that place at an accelerating rate too. So what we see when we look at Japan is the future of the U.S. and it's potentially not pretty. I mean, it could be just this brutal financial reckoning that nobody is prepared for right now. Look over at the crypto guys, and you got entities like Tether that are setting up gold-backed stable coins, and they have to buy a lot of gold and store it to back those stable coins. And Tether is now, in terms of the amount of gold that it owns, it's up in the central bank range there. It's comparable to brand name country central banks. And it's just one stablecoin company. There are probably several others that are thinking about jumping with both feet into the gold market because that's a really logical kind of stablecoin product there. So you've got a lot of really non-price sensitive buyers in the gold market right now. And that doesn't mean gold goes straight up from here, but it means that the wind is at the back of that metal's price. I suspect at some point they fail because the industrial demand for silver is so high and rising, and the supply of silver coming out of the world's mines is inadequate for the industrial demand. And then you've got monetary demand happening at the same time. As gold goes up, silver gets pulled up via the gold-silver ratio, and there's just not enough silver to satisfy all the potential claims out there. So I think everybody's watching this with interest because everybody in this market can see the math, and the math is very unfavorable for the exchanges and great for silver. So seeing that, if you're if you're General Dynamics and you need silver for missiles, you're going to go out and get as much silver as you need for the next few years projected demand, right? Because you're not going to stop supplying missiles to the Pentagon or to any of 50 other countries that are buying from you. Unless we keel over with heart attacks in the next couple of years, we are going to live through that part of monetary and financial history, which is fascinating on the one hand and absolutely terrifying on the other hand.